Live from Bloomberg's world headquarters in Midtown Manhattan, I'm Matt Miller.
And from our studios in Washington, D.C., I'm Kaylee Lines. Welcome to Bloomberg Crypto, a look at the people, transactions, and technology shaping the world of decentralized finance. Coming up, Bitcoin's rally runs out of steam. The CEO of data provider Kaiko joins us to discuss the hurdles that remain and the next potential catalyst.
Meanwhile, Tether's controversial stablecoin is on the verge of recovering all of the market value lost in the wake of Terra USD's collapse less than a year ago. We'll assess the comeback.
And on Capitol Hill, House Republicans unveil a slimmed-down draft stablecoin bill. We'll discuss the details with Dante Disparte, the Chief Strategy Officer for Circle. So all of that is ahead, but first let's get a snapshot of the market. The best way to do that on your Bloomberg terminal, CRYP Go. And what you will find is, as I said, we are continuing to see a little bit of downward pressure for Bitcoin. Right now trading at $27,393, so off of earlier lows, which saw us at the lowest level in about a month. But still, we have to keep in mind we're down about 10% over the last week. Ether, meanwhile, down at 1824, lower by about 0.8% on the day, while some of those altcoins are underperforming to a larger degree. Solana down 1.5%, and then Polygon down the better part of 4%, Matt.
All right, well, we're hearing, Kaylee, more and more forecasts for a big rise in the price of Bitcoin about a year from now as we approach the fourth halving. This has happened in the past. You can see from 50 Bitcoins per block down to 25, down to 12.5, and the next one will give us 6.25. This is a log chart, but you can see after each halving, 12 to 18 months after, you can see a pretty clear peak in terms of the price before we come back down again. For more on this, we're joined by Bloomberg's Katie Greifeld. And Katie, first explain to us what the Bitcoin halving is and why it matters in terms of price.
Well, to start, think about how Bitcoin is actually created. You have Bitcoin miners who basically validate transactions on the blockchain, and in reward, they're issued tokens for their efforts, Bitcoin in this case. So the halving refers to basically a drop in the size of that reward. Basically, they get less tokens as a result of their efforts for mining. So this happens roughly every 4 years. And when Bitcoin launched in 2009, if you think all the way back then, miners received 50 Bitcoins per block that they validated. When this next halving happens, which is estimated to be April 2024, so about a year from now, that reward will be just 3.125 coins. So by current estimates, we're about a year out from that next drop.
Okay, so we have 1 year to go, but we'll all be eagerly anticipating it. When it actually happens, what will happen to the price of Bitcoin in theory?
It's an intense debate, I would say, if you look across the industry. So if you look at previous halvings, very difficult word to say, in 2012, 2016, and 2020, you did see big rallies in the price of Bitcoins in the 12 months that followed. But the debate comes in because it's pretty much impossible to know how much of that had to do with the fact that the reward dropped, or was it just a coincidence when you think about what was going on in the macro environment. So again, pretty impossible to know. But then you look at some of the estimates. We have one from Bloomberg Intelligence, actually, that says if you look at the price of Bitcoin right now, the halving that's going to happen in about a year from now, it's only about 50% priced in. So you extrapolate that out, and they actually expect Bitcoin to rise to $50,000 per coin by this time next year. Of course, there's a lot of daylight between that number and where we are right now.
It's a fun word to say, don't you think? It's like something an elf would say. It's perfect for crypto. It's like something out of Dungeons and Dragons, the halving. All right, Katie, thanks very much. Katie Greifeld there talking about that process with us. Joining us to talk more about that and other market technicals is Ambre Soubiran. She is CEO of digital asset data provider Kaiko. If you're involved in crypto, you know Kaiko well, and so we're really glad that you could come and join us here on set in New York. Thank you very much. What do you think about this, the halving and the price increases that we see after that because people are willing to pay up more for less supply?
So absolutely. I mean, every time if you look at history, obviously the price has increased following a halving event. I think that has to do with just, market dynamics around supply, right? It's all about supply and demand. That's how market prices is being formed in crypto. And so obviously you have a limited amount of new money creation that is being done in the market, and thereby it has a positive impact on price. So that's the, base mechanics that underlies the rationale for having those price increase. And I think that will continue. I mean, we'll definitely see, the less supply, the more demand. That's a general rule of thumb in markets. And so there's no reason that this halving won't do that. Now, that being said, I think there's better awareness now on that event happening. Yeah. And so maybe some of that will be priced in before the actual event. But nonetheless, I do believe there's going to be a price support around that event and following.
Well, there's also, it seems like, a different situation in terms of liquidity now, right? Until this point, we've seen increase in interest. We've seen the hash rate just soaring every time to a higher record and more liquidity. But in 2021, in 2022, that's changed, and now we've had a really big drop in liquidity. How does that affect the prices?
So absolutely. I mean, we've seen a price recovery, right, since the beginning of the year. I think ETH is up 60, or Bitcoin is up 60%, and Bitcoin shortly behind, about 50% up since the beginning of the year, outperforming actually most, or if not all, traditional asset classes. But to your point, absolutely, we have seen a decrease in volume and market depth and liquidity translating into higher volatility. That, for now, is an indication that even though there is a positive, sentiment around the price of those assets, markets are not back to their kind of pre-2022 crisis amounts in terms of volume and market depth, most importantly. Now, that being said, market depth, the way we look at that is really the amount of volume that is placed on exchanges, on order books. That's how we define market depth. And that's interesting, is that a consequence of what happened with FTX, where people actually hold their crypto somewhere else and they only go through exchanges when they want to trade, but thereby there's a bit less depth actually on exchanges before the actual trading event. So that could be an explanation, but clearly the depletion of traded volume and market liquidity and market depth creates this higher volatility environment, which is creating uncertainty in the markets, regardless of prices going up or down.
Do you have a read on who is driving the volume that there is between institutional players and retail?
So we've tried with Kaiko, looking at the data, to use order sizes and a couple of proxies to identify retail trading and retail volume, and it seems that retail trades have been increasing over time, over the past couple of months. So that's something. And then the other thing we've been looking at is that the volume activity during specific trading hours. And interestingly, and maybe that will take us to the next topic on the geographic regulatory landscapes, which is we have seen an increase of trading activity during APAC trading hours, which is something that was mostly driven during US trading hours in the past. So this is two trends that we've been observing in the data.
So is that another way of saying basically that things are moving out of the U.S. and overseas?
Moving out maybe is a bit of an overstatement, but clearly what we're seeing is, following the clear, lowering of volumes and market depth, combined with regulatory uncertainties and the couple of events happening on the U.S. banking side recently. Combine that with what's happening in Hong Kong, where the government and the regulator has been announcing a more favorable, or at least more clear regulatory framework to attract institutional interest, has potentially driven some volume and interest back into the APAC market. We have seen that. We're physically located in Singapore and Hong Kong, and we're clearly feeling that, at least at the institutional level. That's one. Second is clearly we have seen also statements from U.S. exchanges, right, opening derivatives exchanges and derivative trading capabilities outside of the U.S. So there is clearly that uncertainty in the U.S. driving some crypto companies and exchanges to think about their growth plans globally. And
investors are, as you mentioned, focused on, the big original digital assets, Bitcoin and ETH, as they get away from the 21,000 altcoins to some extent, right? How has the staking, I don't want to say experiment, because it's more than that, right? How has the proof of stake transition gone for ETH?
Yeah, so actually, the successful merge back in September was a very big event in the blockchain industry, one that has been slightly overshadowed by the wider macroeconomic environment and challenges that the industry was facing back then, but still a very, very successful event for the world of blockchain and specifically, obviously, Ethereum. And the recent kind of, recent merge, the Shapella update, meant that there was a bit of an overhang potentially on, are people going to withdraw? and is that going to create a downward selling pressure on the price of ETH? And actually what we've observed over the past couple of weeks is that this didn't happen. There's currently 15% of the ETH supply that is staked on proof of stake. And that hasn't changed since, meaning that obviously some people have withdrawn now that withdrawals are possible, but you have an equivalent of amount of people who have started staking. And we're seeing that also driven by the fact that exchanges are offering institutional staking services, and there is demand for that. So I think we can clearly consider that the proof of stake merge and move from proof of work to proof of stake is a very successful upgrade for Ethereum. I am, honestly thinking that Ethereum is going to shine this year in 2023. As you said.
Do you have any forecasts for us?
Forecast? No, I'm not. I wish I had some. but clearly, I'm very bullish generally on Ethereum. You're absolutely right to point out that the market right now is still very much driven by the price of Bitcoin. Assets have been very correlated to the price of Bitcoin, and it's mainly Bitcoin and ETH. All the alts are merely following behind. We did a big analysis ranking, looking at liquidity, market depth, and a couple of other metrics to see what is the actual kind of institutional grade investable universe of those kind of 2,000 something tokens. And the reality is there's about 50 that are actually liquid enough and could support some form of institutional investments. Yes, we're still in.
And so investors, I think, are looking at your research and are agreeing with you and going only into those things. Ambre, thanks so much for joining us. Great having you in the studio here in New York. Ambre Soubiran from Kaiko. Now, coming up, more on the state of stable coins with Dante Disparte, Chief Strategy Officer and Head of Global Policy for Circle.
And Cathie Wood is helping revive the debate about the viability of a spot Bitcoin ETF in the U.S. We'll have details on that bid ahead.
And access all the latest data and news on crypto on the Bloomberg terminal. Just type CRYP GO. This is Bloomberg.
This is Bloomberg Crypto. I'm Kaylee Lyons in Washington with Matt Miller in New York. And Matt, we just briefly have to exit the world of crypto and talk about the world of space. A red headline just crossing the terminal that Japan's iSpace says it cannot confirm if its craft landed on the moon. Now, this is a Japanese startup. It is a private company. This would have been the world's first lunar landing by a private company if it was successful. But again, iSpace can't confirm at this time if it indeed landed on the moon. So we'll keep you updated on that story. But let's turn back to the policy story here in Washington. Matt, Republicans on the House Financial Services Committee unveiled their own version of a draft stablecoin bill yesterday. The document provides a narrower focus and gives state regulators more power than a prior proposal that was a byproduct of bipartisan negotiations. Joining us now is Dante Disparte, Chief Strategy Officer and Head of Global Policy for Circle. Dante testified before the committee last week in its first stablecoin hearing. So, Dante, great to see you. I, of course, saw you in the hearing room last week as well, where there was a lot of focus on the power that states should hold as issuers and giving charters to issuers in the stablecoin space. What is your feedback on this new draft of this legislation?
Yeah, well, this new draft legislation really does respond to some of the big issues we have in the United States, which were not only prevalent in the hearing testimony and my own testimony in the hearing, but one of the gaps that the United States has is that we're alone among the advanced economies in not having a federal payment system charter. And so I think this type of bill does recognize and protect the role of state oversight and state rights, but it does concede an important point to the federal government, and particularly the central bank, the Fed, which is it establishes a floor for what payment stablecoin oversight might look like at the state level. And this, by the way, is not novel. We have a dual banking system in the U.S., which allows for state-supervised banks that have a federal floor. And I think that same paradigm would make a lot of sense for payment stablecoin innovations in the U.S.
But there is a question as to whether or not legislation like this could actually find enough bipartisan support. As you know well, Dante, that hearing last week was quite contentious between what Ranking Member Maxine Waters said about needing to start from scratch, given everything that has happened since November and the collapse of FTX, and Patrick McHenry, the chairman, who wants to push along with this where is there room really for bipartisan consensus?
Well, I think there are a couple of things that both leaders agree to, and we must remember that under the then chairwoman Maxine Waters, a lot of the body of work that we saw, including the 73-page draft stablecoin legislation that was released, a lot of that work was done in the prior Congress under Chairwoman Waters' leadership. And just because the gavel may have switched hands, I think both Patrick McHenry and Maxine Waters have worked in a deeply bipartisan way. And frankly, what they're trying to respond to, in my mind, is much bigger than digital assets or crypto in the United States. It's really a matter of dollar-based innovation and protecting the role of the dollar, not only as a global reserve currency, but also protecting this idea of dollar-denominated innovations in payment systems and market activity more broadly. Those are the stakes. And I think if there was one red thread throughout the entire hearing, both from Republicans and Democrats, but also from all of the witnesses, was in an era of de-dollarization. I think Congress has a unique obligation right now, and frankly, one that touches American national interest, competitiveness, and security, to promote this role of the dollar, not only in domestic payments and banking innovations, but also as an innovation around the world. I think those are the real stakes of this hearing and of this legislative agenda. So I don't think there's that big of a gap. Both parties agree there's a need to legislate. The boundaries of states' rights versus federal preemption are the next set of issues, but I think the dual banking system offers us a history of state oversight and federal sort of floors in banking and payments, and I think that same paradigm could hold true here too.
How far have we fallen behind? I mean, with other central banks introducing their own digital currencies, and the U.S. still worried about stable coins like Circle, have we lost the lead?
Well, it's funny. We started this segment with a rocket not landing on the moon, and it's a good analogy because I've called this a digital currency space race. But like the digital currency, like the real space race, our country and the West won when our political leadership gave us a destination. I do not subscribe at all, and no one at Circle subscribed to the view that we're losing this digital currency space race. If anything, dollar digital currencies like USDC are importing the safety and soundness of the U.S. banking system and are responsive to the entirety of federal sort of reserve board and federal government oversight of money and transmission of monetary policy. Collectively, we've processed more than $10 trillion in payments with USDC. We have a network of more than 190 countries that have active USDC-enabled wallets. And so I don't think the U.S. is losing the digital currency space race, but if we want that leadership to be protected for the next decade, this is where legislation and dollar-based promotion of dollar-based competitiveness will really make a big difference in the long run. It's in the next 10 years that I think the stakes are much higher than they are right now.
Dante, if we get it right, in terms of the legislation, regulation, in terms of the Circle, do we need a CBDC? Do we need the Fed or the U.S. Treasury to have its own stablecoin?
Well, it's a good question. So the question of should the United States issue a central bank digital currency or not? Obviously, both require congressional authority. The Fed and Secretary Yellen and Chairman Powell and others have studied the question of central bank digital currencies quite deeply. More than 114 central banks around the world are looking at it, and most of them are looking at it as a wholesale payments innovation. I think that same operating paradigm makes sense in the United States. You even saw very recently the Undersecretary for Domestic Finance, Nellie Liang at the Treasury Department, gave a speech in which she said a wholesale central bank digital currency could very well be a backing asset for today's generation of payment stablecoins. And so the idea is not substitution of one innovation for the other, but perhaps convergence. In the end, all of these innovations should promote a broad payment systems optionality domestically, protect and preserve the role of the dollar as an international currency, and then finally promote optionality inside the payment system, whether publicly issued or private. I think that's the end state that we should aspire to as a country.
All right, Dante, we have to leave it there, but please come back to us again in the future as this conversation evolves. That was Dante Disparte of Circle. Now, coming up, from the Celsius auction to the spot Bitcoin ETF debate, we'll get you caught up on the other key crypto stories from around the world. And, of course, be sure to check out our Bloomberg Crypto podcast every weekday, wherever you get your podcasts. This is Bloomberg.
is Bloomberg Crypto. I'm Matt Miller in New York with Kaylee Lyons in Washington. Let's get some of the stories that caught our attention in digital currencies this week. Bankrupt crypto lender Genesis Global is trying to save the outline of a deal with its parent digital currency group. Genesis has asked the judge overseeing its reorganization to appoint a mediator before the mid-May due date on $630 million of debt that DCG owes to Genesis. Bloomberg has learned that unsecured creditors want better terms.
There will be two new bidders in today's three-way auction for failed crypto lender Celsius. The new contenders are Fahrenheit, which is backed by TechCrunch founder Michael Arrington, and another group backed by Gemini Trust, which is run by the Winklevoss twins. They join Nova Wolf Digital Management in seeking to manage a restructured version of the bankrupt cryptocurrency company.
And Kathy Wood's ARK investment and crypto exchange-traded product issuer 21 Shares have revived their bid for a Bitcoin ETF. They've refiled their application with regulators. 21 Shares initially filed for the ETF in 2021 and again last May. Both attempts were among the dozens rejected by the SEC. And Kaylee, I feel like this space story has a pretty good connection to crypto. You know, when our grandkids live on Mars, they'll probably use digital currencies in their economy. And private space exploration may be what pushes us that far. Right now, we know that a private Japanese company, iSpace, has lost communication to its moon lander. It was trying to land an autonomous or remote-controlled craft on the moon. It now assumes that it didn't make the landing, but it no longer knows where that craft is and may have crashed or just been lost in space.
Yeah, they say they're still investigating the status of the lander, but that it can't confirm if the craft did indeed land on the moon. And of course, this is significant because this would have been the first private companies to have a successful lunar landing if indeed that had happened. But again, iSpace cannot confirm it at this time. And of course, this follows last week, the Starship launch from SpaceX, which it did get off the pad and above the tower, didn't get too far, but in theory, that was considered a success.
I think they got 34 miles. It looks pretty successful to me until,
a couple
of
minutes
course,
of flight, yeah.
They had to self-destruct. But they want to do it again and continue to try until it's safe enough to launch it with you and me on board.
Well, we'll see about that. We got you covered from space to crypto. Make sure to join us next week. David Bricco is going to be joining us from Paradigm. This is Bloomberg.